someone in the current administration said to Trump, this shit's happening, and if we don't act upon it, we're dead in the water. That these countries together, the BRICS countries, have become coordinated and motivated and sophisticated, and they realize that all of these contracts have a back door. That back door is you can stand for delivery. Now, I used to say less than 1% of COMEX contracts stand for delivery. Remember, over 2 million ounces of gold, 2,160,000 in the first 3 days were posted on the August contract, on the 4th, the 7th, and the 8th, and every one of them stood for delivery, 100%. Where are they going? They're leaving COMEX too. This is a big deal. We have a BRICS storage program with 9 facilities around North America. One of them is COMEX, just one, and that's BRICS JFK. The rest aren't in the COMEX ecosystem. Client's got a bunch of 1,000-ounce bars there, says, I want to move to Salt Lake City. Sure, I say, if interest rates move too high, it's the reset. Because of the distortion of asset prices, the suppression for so long, everything got crazy high in an environment where money costs nothing and no lending standards. So you have an inverse correlation between a spike in interest rates and the value of your stock portfolio, the value of your bond portfolio, the value of your real estate market. And what do you think the banks are loaded up with? Treasuries. What happened when rates went above 5% on the 10-year? Boom, Silicon and Signature break. What happens if they really spike? What about the insurance companies? What do they have on their balance sheet? Treasuries. And so it's been an environment where, we've lived a really, really great life for a while here, and we've had an exorbitant privilege that we've screwed up. Our fiscal responsibility and our monetary brain dead management of monetary policy has been a laughingstock for the last several years, as far as I'm concerned. So that kind of lays the framework for where we are right now and what I believe is happening. So with all of that being said, I started doing these videos in 2019, and the first thing that I noticed in 2019 was the BIS reclassifying gold tier 1, which is a big deal. And the central banks going on a buying spree, which is a very big deal. And accumulating. Central banks pulling gold back from the Bank of England and the New York Federal Reserve, a big deal. Not only was it tier 1, not only have they gone on a massive buying spree, they've repatriated their gold from the Bank of England and the New York Fed, which would give direct access to the LBMA and the COMEX. We don't want the convenience, we want our metal. Thank you very much.
Global reserve managers quietly increased physical gold purchases after 2018, accelerating through 2024 and into 2025 as geopolitical risk, inflation, and currency concerns rose. Surveys and public data show many central banks expect reserves to grow, and official flows confirm sustained buying. This is strategic reserve diversification, shifting allocation away from some paper claims toward tangible assets that cannot be created by monetary policy. Pace and scale vary by nation, but the message is uniform. Institutions are hedging systemic currency and settlement risk by quietly increasing physical holdings while global reserve frameworks and market liquidity evolve.
This is a trend that we have continued to see year over year over year for the last several years. The central banks are buying gold and silver, but mostly gold, like it's going out of style, and doing so very quietly, and using the suppression of the Western paper markets against us. They've become coordinated, sophisticated, motivated, and they know what we're doing. I'll give you an example. The BRICS grain exchange is under development right now, and I've done 5,000 videos on the BRICS. I've talked a lot about the BRICS, and I'll get to, in a moment, why the poo-pooing and the naysaying of it is a massive mistake. But I've done all these videos on the BRICS and say they know what we're doing. And that's why you're seeing all these countries stand for delivery and continue to repatriate. And so the guy that's behind the BRICS grain exchange was interviewed, and he said, we produce and consume more grain than they do in the West, but we can't control price. That's controlled on COMEX. But with the advent and development of this new grain exchange, well, that's going to change. Well, do you not think they know what we're doing with the precious metals markets and with all of the commodities? Chinese bought the London Metals Exchange, not the precious metals, but the base metals. And they're building warehouses in China they've already built them, to house the metals traded on the London Metals Exchange, all the base metals that you would need to build an infrastructure from steel and lead and tin and all of these things. They've developed the Chinese Belt Road Initiative, right? And this is 150 plus countries, the largest infrastructure project in human history that is connecting Asia, Africa, South America, and building through a series of roads and bridges and maritime channels. It's just commerce and military patrolling this infrastructure. It's the Panama Canal on steroids, but the common denominator here is all these countries are massively resource rich. And so China comes in and builds the infrastructure and gets a piece of the action. And all of this stuff is connected to resources and the ability to bring resources to market. So
initiatives like a BRICS grain exchange and regional trading platforms signal a larger trend. Commodity pricing and settlement are being relocalized. These efforts aim to trade staples and raw materials in local currencies, circumventing reliance on legacy Western clearing hubs. Infrastructure projects, alternative payment corridors, and coordinated exchange development give producers and consuming states more leverage over price formation and delivery logistics. When pricing power decentralizes, dominant venues lose influence and global risk transmission changes. That shift can alter how shortages ripple, how prices are hedged, and how states secure critical supplies, all while reshaping the geopolitical architecture of trade.
When we look at where we're at right now, there is a race for commodities. There is a race to accumulate real tangible things at the expense of U.S. Treasuries. We're seeing these countries no longer wish to really hold U.S. Treasuries. And since 2014, net, no new central bank buying of U.S. Treasuries since 2014. Countries like China have gone from first to third in Treasury holdings, slowly selling them off, not too fast, to cut off their nose to spite their face, where they're now supplanted number 2 by the United Kingdom. 2 of the most broke countries in the world buying each other's debt. It's like 2 drunk guys at the end of the night leaning against each other so they don't fall down. That's the US and the UK right now. So all of this stuff doesn't work. And I've been talking about all of this for a very long time, saying they are beating us at our own game, these countries. They understand that we've been suppressing the price. We've been suppressing gold because of a term called Gibson's paradox, which is the inverse relationship between real interest rates and gold. So if you're going for all of these years to suppress interest rates, to create a distortion or an illusion of prosperity in 401ks in your house, you have to step on the canary in the gold mine. That's the price of gold. So all of these central banks in the West would through the commercial banks in their countries, like UBS, like Bank of America, like Goldman, like JB, like Deutsche Bank, they were all collusive. They would sell metal short into the market that they would lease from the central banks at next to nothing, 0.5%. They would short the metal into the market, drive the price down. With the proceeds of those short sales, they would buy U.S. Treasuries and capture the spread between the 0.5% lease rate and whatever they were getting on the Treasuries. And they're being told to, at the highest level, this was being done specifically to suppress interest rates, to suppress gold, to perpetuate the illusion that fiat paper currencies and cash instruments were the road to prosperity. And it worked for a very long time until where we are now. Things aren't working that way because no one wants our treasuries anymore. Remember, it was the purchase of treasuries that kept interest rates low, asset prices high, etc., allowed us to live this great standard of living. These things are changing. And I believe that
record physical deliveries and large withdrawals from exchange vaults are changing market mechanics. When bullion leaves regulated exchange ecosystems for sovereign or private storage, it often can't re-enter without costly reassay procedures, so it effectively exits the liquid quoted supply. That removal tightens immediate availability and creates a meaningful divergence between paper claims and deliverable metal. During stress, the separation between futures-based prices and physical premiums widens, forcing participants to confront scarcity, logistical friction, and counterparty risk. Markets built on abundant convenience must now price delivery risk, and that repricing compels traders and holders to rethink exposure.
someone in the current administration said to Trump, this shit's happening, and if we don't act upon it, we're dead in the water. That these countries together, the BRICS countries, have become coordinated and motivated and sophisticated, and they realize that all of these contracts have a back door. at backdoor is you can stand for delivery. Now, I used to say less than 1% of COMEX contracts stand for delivery. Remember, over 2 million ounces of gold, 2,160,000 in the first 3 days were posted on the August contract, on the 4th, the 7th, the 8th, and every one of them stood for delivery, 100%. Where are they going? They're leaving COMEX too. This is a big deal. We have a BRICS storage program with 9 facilities around North America. One of them is COMEX, just one, and that's BRICS JFK. The rest aren't in the COMEX ecosystem. Client's got a bunch of 1,000-ounce bars there, says, I want to move to Salt Lake City. Sure, I say. I talked to my Royal Canadian Mint guy. These are all 1,000-ounce bars that he has staged at BRICS JFK. He leaves them there for companies like me. Anyways, guy says, you don't want to do that, Andy. I'm like, why? He's like, once you leave the COMEX ecosystem, that's it. They have to be reassayed to get back in. And I'm like, well, so let me get this straight. It's sitting in BRICS JFK vault. It will be put on a BRICS truck, driven to BRICS Salt Lake City, where it's put into a BRICS vault. No one touches it but BRICS, and it's no longer in the COMEX. That's right. Once it leaves the COMEX ecosystem, if it goes back in, doesn't matter if it's BRICS to BRICS.
States now treat minerals, metals, and food as geopolitical instruments and invest in ports, warehouses, and transport corridors to secure supply. Large infrastructure projects and bilateral finance deals often exchange capital for resource access, locking long-term flows to national strategic plans. That means control of pipelines, stockpiles, and storage becomes as important as ownership of reserves. When physical assets are embedded in diplomatic or military strategies, markets change. Buyers value guaranteed delivery and sovereignty over short-term financial returns. The result is higher demand for tangible, deliverable inventory and growing divergence between paper liquidity and real-world supply.
This is a COMEX facility, JFK. The rest aren't. Once it leaves there, it needs to be drilled and assayed at a considerable expense and time lag, and ain't ever coming back. So when we see all of this metal leaving the exchanges, this has to be understood. This is hugely sophisticated and very hard to do, and big money, right? North of 100 billion worth of gold has come into this country since the beginning of the year, and no one knows squat about it. Who's been buying it? Where's it been going? A lot of it has left the exchange. I mean, bye, gone, goodbye. And it's getting crazier. All right, so why do I think someone within the administration has told them about it? I'm gonna try and tie all this together. Because since November, we become net importers of gold. More gold has come into this country than at any time since the end of World War II. And the reason it all came in then was that was part of the world reserve currency deal. People would send us their gold. We would say to them, look, you're in Europe, it's been ravaged by 2 world wars. Send us your gold, we'll hold it for you. You can always exchange, you'll get dollars, right? We'll pay you $35 an ounce for your gold. We'll hold it for you. With those $35, you can buy our treasuries and earn a yield on your gold. And anytime that you want your gold back, give us $35, we'll give it back to you. So the dollar was backed by gold. It was as good as gold as far as foreign banks were concerned. And then in 1971, when de Gaulle from France came and sent warships over to New York Harbor filled with dollar bills, saying, you know, you're printing way more dollars for the Vietnam War than you should really have.
Rising rates, central bank accumulation, and market fragmentation force a recalibration of risk frameworks. Investors must reassess duration exposure, counterparty concentration, and the difference between contractual claims and deliverable assets. Hedging strategies that assumed abundant liquidity become fragile when physical supply tightens and settlement frictions rise. Policymakers face a stark choice: rebuild credible fiscal and monetary policy to restore trust in paper instruments, or accept slower fragmentation as alternative systems and reserve strategies mature. The transition will be uneven and geopolitical. Surviving it requires humility, contingency planning, and an explicit account of where real liquidity actually resides.
Fort Knox, so we're gonna stand for delivery, thank you. And we did. We bled out almost half of the gold held at the Treasury to France and Switzerland and other countries who called us on our bluff, and then Nixon closed the gold window in '71. And so, you know, it's a situation where we went back on our promise. Mm-hmm. So the dollar's really been backed by nothing. So in any case, where we are right now. Someone said to Trump, I believe, if we don't do this, we're in trouble. So they developed this ruse, if you will, in my opinion, of gold tariffs. And so they start draining all the gold and silver. And all of a sudden you see that we know of over 100 billion come into the country in deliveries, much of it leaving the COMEX market. Where the hell is it going? And the first 5 days of the August contract, we saw roughly 6.5 to 7 billion worth of silver come in, and almost all of it left. Now ask yourself, those of you that have ever held a silver mint box before, which is 500 ounces and 40 pounds, who's taking possession of 7 billion worth of silver? Okay, because that box is, you know, what, 16,000 bucks or 18,000 bucks? Who's taking possession of 7 billion worth of silver? Where's it going? How many semi-trailers is that? So, and it's leaving the ecosystems. All this metal's coming in. Much of it, I would argue, that's coming in we don't even know about. It's coming in through, not through the COMEX, going into private vaults like JP Morgan's vault, or, you know, whatever, that we're just not being told about. And maybe it's Secretary Bessent through the Exchange Stabilization Fund under the guise of, or under the purview of national security, so he doesn't have to tell Congress yet.